Have you ever found yourself agonizing over a $5 coffee purchase, debating whether you can afford it, only to turn around and blow $500 on a spontaneous weekend trip after getting a bonus? It's the same money. $500 is $500 regardless of where it came from. Yet, your brain treats that money completely differently. If you've experienced this, you're not irrational, you're human. And you've just been caught in the powerful, often destructive trap of mental accounting. I'm Dr. Mindvist, your behavioral finance expert, and today we're pulling back the curtain on this hidden way you budget that is actively sabotaging your savings and keeping you from true financial freedom. Mental accounting is a term coined by Nobel laureate Richard Thaler. It describes our tendency to assign subjective labels or categories to money based on its source or its intended use. Think of it this way: instead of seeing all your money as one big, interchangeable pool, which is the economic principle of fungibility, you mentally sort it into separate, labeled buckets. You might have a rent money bucket, a fun money bucket, a savings bucket, and a bonus bucket. When you get a bonus, that money goes into the bonus bucket, and suddenly it feels like free money, making it easier to justify a splurge. The money in the rent bucket, however, is sacred and untouchable. The problem is, fungibility is the bedrock of rational finance. $1 earned from your salary is financially identical to $1 won in the lottery, or $1 saved from a coupon. Mental accounting violates this by making $1 feel lighter or easier to spend than another, simply because of the label we've slapped on it. Let's look at 3 classic examples of how this bias sabotages your financial life. Imagine you receive a $3,000 tax refund or a work bonus. Where does it go? For many, this money is immediately placed in a mental account labeled windfall or spending money. It feels like an unexpected gift, so we treat it as such: a new TV, a vacation upgrade, or a shopping spree. The sabotage: that $3,000 could have been used to pay down a credit card with a 25% interest rate. Financially, the most rational move is to use the windfall to eliminate the most expensive debt. But the mental label of free money overrides the financial logic, leading you to spend it on consumption while your high-interest debt continues to compound. This is a classic experiment by Richard Thaler. Imagine you buy a $10 ticket to a play. As you enter the theater, you realize you've lost the ticket. Would you buy another $10 ticket? Most people say no. They mentally account for the loss in the entertainment budget, making the new ticket feel like a $20 expense. Now, imagine you arrive at the theater and realize you lost a $10 bill on the way. Would you still buy the $10 ticket? Most people say yes. The outcome is the same. You are $10 poorer. But in the second case, the lost cash is mentally accounted for in a general funds bucket, separate from the entertainment bucket. The mental frame changes the decision, even though the financial reality is identical. This is how mental accounting makes us inconsistent and irrational. Many people categorize debt. They might aggressively pay off a 0% interest car loan because it feels like a good, tangible asset, while only paying the minimum on a high-interest credit card. They've labeled the car loan as good debt and the credit card as bad debt, but their actions are financially backward. The sabotage. The mental category overrides the mathematical priority. You are paying 0 interest on the car, but you are hemorrhaging money on the credit card. The only rational approach is to attack the highest interest rate first, regardless of what you bought with the money. So, why do we do this? Mental accounting is, ironically, a flawed attempt at a self-control mechanism. We create these categories to impose discipline and track spending. We tell ourselves, I can spend this $100 on clothes because it's my shopping budget money. It gives us an illusion of control. It works fine for small, frequent expenses, but it fails spectacularly when it comes to large, infrequent decisions like managing debt, saving for retirement, or handling windfalls. The categories we create are often too rigid and don't align with true financial priorities. We are prioritizing the feeling of control over the reality of financial optimization. The good news is that once you recognize this bias, you can build systems to bypass it. Here are 3 actionable steps to defeat mental accounting. When a windfall arrives, immediately mentally transfer it to the most financially logical account. That means highest interest debt first. This is the Debt Avalanche method, which is mathematically superior to the debt snowball. You must treat all debt as one pool of negative money and attack the one that costs you the most. Don't let the mental satisfaction of paying off a small balance first override the financial necessity of minimizing interest paid. The best way to defeat an irrational mind is to remove the decision from its hands. Automate your savings, investments, and debt payments immediately after your paycheck hits. This is a pre-commitment strategy. You are making the financially rational decision before your emotional brain can label the money as spendable. If the money is already gone to savings, your mental accounting system can't even begin to categorize it as fun money. While mental accounting is bad, using separate labeled bank accounts can be a positive form of pre-commitment. Open a separate high-yield savings account for your emergency fund and another for your long-term goals. The key is to respect the hierarchy of financial needs. Your emergency fund must be fully funded before you start a vacation fund. Use the physical separation of accounts to reinforce your rational financial plan, not to justify irrational spending. Mental accounting is a powerful, invisible force, but it is not unbeatable. Your money is fungible. Don't let your brain's internal bookkeeping sabotage your financial future. The first step to financial freedom is realizing that your biggest financial enemy is often your own mind. Now, I want to hear from you. What's one mental account you're going to break today? Let me know in the comments below. If you found this video helpful, please like and subscribe for more insights into behavioral finance. Thanks for watching, and I'll see you in the next video.